Okay, I'm just going to wait another 30 seconds here or so before I start this webinar. Okay, thanks for joining me this afternoon. My name is Scott Smith. I am a senior technical analyst here at briefing.com for the last 10 years. And today's webinar is entitled Turning Profitable Day Trades into Winning Swing Trades. At the end of this webinar, there will be emails and contact information, and hopefully we have enough time for some Q&A. If anybody has any questions, I'll try to answer them. Hopefully it doesn't go too long. I did do a previous recording of this webinar about a month ago. So this is kind of an update to that. I do use some of the same examples, but I also edited some new ones, and I tried to get a little bit more clarification on some questions that I've received from the last one. So going forward, let's see if we can start this webinar up. Okay, so the first thing I want to cover is the difference between day trading versus swing trading. And these are my definitions. These aren't any sort of formal definitions. So the first thing is, when you're day trading, you're trying to take advantage of short-term price movements, you're most likely intraday or perhaps overnight. And the key there is to trade larger size with tight stops. You have this all-in and all-out mentality. And the theory is that the smaller gains should add up to bigger gains over time. When it comes to swing trading, it's a little bit different. You're trading a little bit smaller or medium size, and you're usually willing to give price action a little bit more room to work in your favor. You're trying to capturing more of a momentum type of move or play over the course of the next few days to the next few weeks to ride the trend out, so to speak. A lot of people tend to approach this with more of a scaling in or scaling out mentality. The whole theory here is also to get more of a steady flow of medium to larger gains, as opposed to those shorter, smaller, quicker gains that add up. This one you're really just kind of riding along and going for the ride. So I have a theory that basically says that the best swing trades are going to start off as winning day trades. This may be a little self-intuitive, but basically when I go into a position, say I'm using 300 shares of stock, I want to make sure that when it starts to work into my favor, I'm going to peel something off. I'm going to treat it as a day trade initially. So if I got long 300 shares of stock and it moves $1 in my favor, I have a choice of selling a portion of that position, either 100 shares, 200 shares, or maybe 50 shares. And then I'm going to goes up another $2. Say it goes up another $1 in my favor to $2. Well, then I'm going to peel something else off, and then I'm going to somewhat trail the rest of that balance behind it, and kind of move that whole winning day trade into more of an overnight swing trade position. And I'm going to kind of let that remaining balance work in my favor. The reason I do that is to free up a lot of capital, the initial capital I put up, and by doing that, I'm one of those traders that likes to see my account grow. I don't like to just kind of sit there and say, all right, is this the high? Is this the low? Should I get out? Should I get in? I always like to take something off and put money in the bank, so to speak. And I feel just much more comfortable doing that. I feel much more comfortable holding a 200 or 100 shares of stock overnight than I do a full position of 300 shares, which puts me to more of a full-size risk overnight, which could be subject to upgrades and downgrades or earnings or et cetera. So there's something about the way I approach the market where I feel much more comfortable reducing my exposure to the market as quickly as I can during the day as prices move in my favor. So the three components that I'm always following is A, I'm taking partial profits. B, I'm going to be trailing stops on the remaining balance as long as the price action continues to work in my favor. And then, of course, the third one is just cutting losses. A key part of this game is just admitting that you're wrong. I know it can be really, really hard to do, especially after you put all the time and the effort in to finding a right setup, to finding a right entry, to participating in the market, to getting the nerve to pull the trigger. and then you basically have to tell yourself that was all wrong. It's a difficult concept, but it's key to preserving your capital for the long run. So these three examples here, these are just showing different types of methodologies of ways of getting out of your share size. You can get out, you could scale out a lot at first for the first dollar, or and scale out in smaller increments as price goes higher, or you can do the vice versa. I prefer the bottom one here, where I basically will sell 100 shares up $1, 100 shares up $2, and then pretty much let the 300 shares ride. You kind of have to experiment with it if you're not sure which one you like. These could be contracts as well, for option contracts or future contracts. But I highly recommend experimenting, finding one that you're most comfortable with, one that makes most sense to your comfort zone, and going forward with that type of philosophy. I have a tendency to approach the market, particularly on the trader site, on the trader service. I have a very loose interpretation of the charts, and what I mean by that is I try not to trade down to the exact penny. When I started this business over 15 years ago, everything used to trade in eighths, which is about 12.5 cents. And so for me to be, putting my stops to the penny, and to me to be panicking over a 10, 20 cents move, it's not worth the headache in my mind. I try to look at markets more in a 50-cent to $1 increments on the charts. As long as I'm somewhere around 50 cents, as long as I'm in the right figure, the whole number itself, that's the zone that I'm going to be looking at. And that's basically how I approach the market from a swing trading and day trading perspective. I focus on zones. I focus on areas, levels, support, resistance, moving averages. And over the years, you just learn that, very rarely do things trade to the exact penny, and more often than not, price action will either go through a particular level and come back, or else it would just come shy of it and then rally or tank from there. So you kind of have to have this loose interpretation of what you see on the charts, and try not to play your hand so tight, so to speak. There was an excellent quote from Bruce Lee, for anybody who's a martial arts fan. He said, "Empty your mind, be formless, shapeless like water." And I think this is really kind of the way I approach trading. Is I try to, it's not to say that I don't have a bias long or short based upon what I see, but I'm definitely going with the flow of the market, going with what the market gives me, and I am adjusting and adapting to that. And which is kind of the same way, like you're going to see a lot of examples of what I'm talking about. So in the last webinar that I did a month ago, I did mention the term opening reversals a lot, and people wanted clarification on this, so I put up this extra slide here. And on the left-hand side, you can basically see the three bullish setups that I watch for all day long, especially off the opening in the first hour, as well as the bearish setups that I'm watching. And it may look a little confusing here at first for anybody that's not too familiar with their chart reading abilities. But the main premise here is you're looking for price action to go from negative to positive, or it's on the bullish side, or you're looking for it to go from negative to from positive to negative for a bearish setup. And when taken into context on the daily chart of whether you have a bullish bias or negative bias, if you wait for these setups, you're going to put the odds in your favor. So just to simplify everything is, you can always go back, and this video is recorded. You can go back and you can take a look at these images I drew up. This is not representative of a 5-minute bar or 1-minute bar or a 30-minute bar. It's just basically what you're going to see these patterns a lot during the first 30 minutes to an hour every day. But the whole key here is to recognize when a price goes through this what I call the neutral zone, which is the difference between the current day's open and the prior close. And when price goes through the neutral zone, if there's any sort of trapped positions from previous bars, and you're bearish, you're going to want to take a short, and where your risk is. That's the beauty of it, is that you're going to know when price goes through the neutral zone. You can easily put your risk at above the high of the current day or the high of the opening range, and vice versa for the bullish setups here. I'm just going to move right into some examples here. I do have a tendency to talk a little bit long when I get to the examples, so I want to make sure I have time for Q&A. So one of the trades that I took on our trading service back in late August was Amazon. It had shown up on one of my oversold scans from the TA page, the TA scans page. I think it also was showing up as one of these trading around the 100-day moving average. And I slapped a 50% retracement on it, or Fibonacci retracements, and I saw that the 50% retracement was around 279. The 100-day moving average was around the same area. And then when I looked back on the chart to see if there was any prior support or resistance, you can see that this was right around that the June highs, July breakout point. So overall, I saw this 279, 280 zone as an area where I want to start participating in, where I want to start looking for a decent day trade to turn into a swing trade. Stock was definitely oversold, on a short-term basis for August, and there's also an RSI positive divergence. So I was on the day that I got the signal and I started looking at it. I was looking at it right here. You can see this arrow, hopefully. And if we look at the intraday action, on August 29th, about 15 minutes after the opening, I put out a trade idea saying that there's an opening reversal pattern off this 280, 282 support area, and you can see right here here was the close and the stock opened lower. There was a strong reversal within the next 15 minutes, and price went positive. That goes back to the opening reversals that I just showed you. So we got long right around here, around 282.75. And on a high-priced stock like this, you have to give it some room to run. So I was willing to risk, I think, approximately, I think it was $2.50 or $3, risk under 280. So it was pretty much around the prior day's lows and the morning low. Unfortunately, we caught that around 283. It broke out here, and it ran up to almost 286 for almost a $3 gain. We did take a partial profit into that type of strength because that's what we do with the day trades, like I showed in the earlier slides. I always want to try to reduce my exposure, before I start holding a winning position overnight, or before I start holding it in the afternoon, especially when it's up $2 or $3 in my favor. Now, unfortunately, I did hold it overnight, and I kept my stop down here around the 280, 281 area. And if I go back to this chart, you can see that the next day it traded all the way back down to 280 level, and we were stopped down the position. So, obviously the next day on September kicked up, it gapped higher, it gapped almost $5 higher, and then just took off and started running. There was not an opportunity for me to get in because I did not like the setup. I did not like the fact that the opening reversal that I took a long trade in was basically erased the next day. So even though the price level was still strong there, I was waiting for another setup early. If it had it set up earlier around on September 1st, around 280-ish, then I definitely would have tried looking at it. But since it gapped up, I kind of just backed off the whole position. Now, I am going to show examples of things that do and don't work out as well. So Apple was another stock that we looked at back in mid-September. It was aggressively being sold off at that time, and it showed up on the TA scans page as a oversold candidate. And again, I put a Fibonacci retracement on the chart from the lowest low to the highest high, and I had the 50% retracement in effect here. I had the 100-day moving average. RSI 5 was in oversold areas, and then when you look back on the chart, you could see that there was a previous highs, which should act as new support for a stock. So when the stock opened up that morning, this was an opening reversal pattern that we had here on the 5-minute chart. You see the close was up here at 450, stock opened at 448, and immediately we had that straight 1-bar opening reversal, and we recommended jumping aboard it around 451. By the first 2 hours, we were already up $7, and we were taking partial profits off the table there. I still hold a portion of this as of today. In fact, I think it's up trading over, where'd it go? It went over $510 recently, I think. So we have a really, really nice gain of about 60 points. Granted, it's only on one contract, but still, that's basically what I do. When I get a winning position, you know, and it closes strong in my favor, and then you see it go higher the next day. It ran up to 470. I think it was up to 480 in 3 days. You know, I'll trim as I go higher, but that remaining 100 shares or that remaining one contract, I'm just going to basically let it ride. To me, that's where the free money comes into play. It's gravy, so to speak. You just kind of want to let that momentum ride out for as long as you can. You know, if it starts coming back in real hard and real fast, well, then you have to deal with the situation. But for the most part, when you get a good entry in a stock and a good day trade, you know, I really always recommend keeping an odd lot. Keep 50 shares on. Keep 100 shares. Keep something small on so you can ride out the momentum. Here's another example is Apache. On August 20th, the stock was getting hit really hard, down from about 82 down to 70, I think it was 75, 74 in about 5 days here on heavy volume. But it came up on my screen, again, as an oversold candidate on TA scans. RSI 14 was under 30. There was a 62% retracement off the spring lows and the summer highs. Price was closing below the lower Bollinger Band. You had a gap and a wide range bar down. The stock just looked ripe for some sort of bounce. So once it took out the that sell-off bar's low, I was basically waiting for some type of opening reversal to set up there. So you can see it about half hour after the market opened, price had already probed the prior day's low, basically running stop orders for people who were trying to catch the bottom there. And then once it reversed, and here's the 5-minute chart of that, you can see price opened a little higher, took out the prior day's low, and then it just came screaming right back through the opening range. We jumped on board around 67 area, wrote it up for about $1 gain. I was not quick to take profits on this one, mostly because of the significant size of the drop that occurred. Price action was still outside the lower Bollinger Band. And I just felt like we can easily get maybe a move back to 78 or 79 sometime over the next day or two, if not that day, just because of the extreme oversold condition I saw in this name at the time. So we did not take a partial profit at 77. So we did hold on to this overnight. Now, obviously, if you're trading larger size and you weren't comfortable doing that, you know, taking $1 profit on this type of trade, you know, by all means, go ahead and do so. But we held it overnight, and when it started trading above 77, we locked in $1.25 as it came into this prior resistance area of the opening range of a couple days earlier. And you know, we just kind of trailed the balance a little bit, and then fortunately, 2 days later, the stock just went higher again and went into this bearish gap zone around 78.50, 79, and we managed to lock in a profit of about $3. So hopefully you realize, I mean, I'm showing examples here. So the main premise is that I'm looking for areas of high probability on the daily charts. You know, I'm looking for the signals. I'm using standard indicators, oversold, overbought. But I'm not just using them in a vacuum by themselves. I'm looking at where are they at different levels, where are they at Fibonacci levels. You know, and when I see something that's setting up there, well, then I'm going to be keeping it on my radar during the morning, the first half hour or hour the next day, and I'm going to be looking for particular opening reversal setups, something that tells me that the selling is done and that buyers are willing to step in and you know, actually take a position in these stocks. A more recent example would be Devon Energy. And you can see here in October, it showed up on the TA scans page as a breakout candidate this day right here when it broke out over 60. You know, and the longer-term chart showed that this price action has actually been in a really long multi-month consolidation phase. You know, I know the previous examples for September then August that I used were stocks were tanking, you know, multiple days in a row, and I was playing a bounce. But this can also be applied to more bullish patterns such as consolidations and breakout plays. So the price broke out and above 60 on what day was that? October 11th, and so that automatically put it on my radar. I'm sorry, it showed up. Broke out on October 10th, which puts it on my radar. And you know, price action opened a little lower on the 11th, And so essentially I was waiting for that opening reversal pattern to show some sort of continuation of the momentum, continuation of this breakout. And this is such a beautiful long-term chart that I just felt like this is one of these stocks that I have to play if it does start showing continuation of the momentum. I was also pretty bullish on the energy sector and natural gas sector as a whole, as many of those stocks have been trending higher during the last few weeks. So this is one of these stocks that I was really willing to take a jump on board for the breakout. And luckily, we did catch that breakout, and 2 or 3 days higher, we held on to some of the position. We sold out for a 250 gain, and some news came out 2 days ago, 3 days ago, and the stock gapped up and gave us a gain of about $6. And we took the majority of the position off, and we're holding a very small position left as on the swing balance, right around the 63, 64 area. To show the intraday action on that chart, over here was the breakout day. You can see price opened higher and ran strong and finished with a close above 60. And here's that opening reversal neutral zone I was showing you earlier, where price closed here. Price actually opened lower, so it's just a matter of waiting for some type of reversal back through the neutral zone so price can go back into positive territory. And when I say positive territory, I'm not just talking for the day. I'm talking above the open and above the close. So when it did, we jumped on board in the low 60s here. There was a beautiful day trade. If you took on size, say you're trading 1,000 shares, you caught about 25 cents there. That's not my game, but if it is, usually these type of patterns are usually good for some type of smaller gains. 25 cents or so if you're scalping that. I usually, like I said, I trade a lot smaller, and I'm usually trying to go along for the bigger ride, the bigger picture, especially if I really like the daily chart. So if you did hold on, you did get about $1 gain towards the end of the day, towards midday. So you could have peeled off a partial profit, and I think we recommended that on the site. If you took on some bigger size, that you should try to scale back on it. But yeah, this turned out to be a really nice winner. I know these have a lot. I'm showing a lot of energy names because, like I said, I was really turning bullish on the charts of the XLE, the XOP, and the OIH. I feel like their relative strength the last couple of weeks has been standing out, and there were really nice consolidations and pullbacks setting up in them. So most of my examples and my positions have been stemming from that group. Schlumberger, another example of a stock that was on the radar, and once it started to break out here, it just looked okay to jump on board. Now I didn't go after the actual opening reversal pattern, but if you look at the chart, this is my long right here. It was more of an opening tight consolidation and a breakout above 83.50 that we jumped on board. But one of the reasons why I liked it is because the prior day had this nice opening reversal pattern. Now I missed that because it does happen. You can't catch every single move all the time. And then prior to that was this little gap up trend day breakout type of move, which is very similar to what we saw on Devon. When it did its breakout, it had a gap up, it trended, and then you saw this opening reversal follow through. And pretty much the same exact activity was going on here in early September for Schlumberger. Was it gapped up, had a nice trend. It looked like it was about to break out. This was September 1st here, so it had the potential to break out of a nice long consolidation right above the 20-period moving average that it was holding tightly right here. And then it had that opening reversal pattern, so we could have easily gone along 82.50 had we recognized that at the time. It wasn't on any of my screens, or I just missed the alert, but that would have been a perfectly acceptable entry right there. But because of this bullish activity here, and because of the overall daily pattern, once I caught on to it, I figured I had to jump on board, and I was willing to give it, I think I said a $2 risk, right? Yeah, I was giving about $2 risk for the swing, which basically came down to these lows down here where the lower trend line was, the $80 area, or if it started cracking below the 20-period moving average, that would have been more of a concern for me. It would have been falling back into this gap area. So it's one of those things we just jumped on board. We did catch a nice dollar almost immediately, which is always a great sign to peel something off the table. And then the following day it just kind of gapped up, came negative, and then you had that strong first hour, 30-minute reversal pattern, which again, it's bullish confirmation. I mean, that's one of the key things you have to recognize when you're trading, is once you find a strong pattern that's working in your favor, you know, and you try to find this low risk entry, as long as you're getting confirmation, and one of my favorite confirmations is this opening reversal pattern. It's where they open a stock, they take it down below the low, they kind of shake out the weak hands, they have everyone jumping on board short, you know, and then they just rip it right back through the opening range, back into positive territory. Those are really excellent day trading opportunities, and they set up over and over and over again. My advice is to definitely be more focused on the trend if you are going to play those, you know, or focus on the extremes. Make sure there's something on the daily charts that is setting up. You know, like I said earlier, the best swing trades are going to stem from the winning day trades. But you can also say it vice versa. You can also say the best day trades are going to stem from the best swing trading opportunities. It kind of goes both ways. Cheveron is another example. So just again, this is another example of a loss that I took. Just to show you that not everything is perfect. I didn't, you know, obviously I cherry picked ones to get my point across, but they don't always work in our favor. On October 4th, Cheveron showed up on the TA scans page as an oversold candidate. RSI was slipping below 30. The stock price was breaking down below the 200-day moving average. It was down probably, looks like it was down about almost $8, $9, 7% it says here in 11 days. And it was coming into this August low. So even though it was below the 200-day moving average, you know, and it was at the August low, I'm thinking that there has to be some sort of bounce activity coming into the name soon. You know, maybe for a good $2 or $3 to take advantage of. So on October 4th, we did jump in. I believe there was an opening reversal that I jumped on board around 118 and a quarter, and I was willing to risk probably about $1.50 or so. You know, because it is a higher price stock, and you know you can't really put tight stops on these types of things. You know, and this goes back to what I said earlier, the way I approach the market. I have a very loose philosophy. I'm looking for certain patterns around certain areas, but I'm not playing it to the penny. Even with my day trading, I'm just not playing it to the penny. I got to give stocks the wiggle room to work in my favor. Ideally, when I see the patterns, when I see the opening reversals, when I see the bullishness come in off a key area, it should continue to work in my favor. Any sign of failure is usually a sign to get out. You know, so we did take the long here around 118 and a quarter, and we did get stopped out for about $1.50, I think $1.75 loss as that failed the next 2 days. You know, but even though it failed, I still kept it on my radar because it was just a very oversold name at this point. Now it was down about 9%. It was taken out its June low, I believe. There was the Fibonacci retracements were back in play around this 115 area. RSI was more oversold. I was a little bit more cautious this time, though, about getting long, you know, any sort of weakness or an opening reversal. So on October 10th, I put out kind of just this general radar comment, just saying, hey, you know what, I'm watching this stock real close, and I think there's more potential for this to reverse. And there actually was a bullish reversal that day. There was an opportunity to jump on board. I passed on it just because it seemed to be lagging the market as a whole, and the seller in that stock, you know, still seemed to be keeping pressure on and wasn't really allowing a higher high to be made. Come the next day, there was the opening reversal trade. Price actually made a higher high, I believe, and we jumped on board around 116.50. We peeled some off after we made about a $2 gain. We made our losses back from a week earlier. And then we peeled some more off around 120 for about $3.50 gain. And we're still holding on to a portion of this with our remaining stop right now around break-even 116. You know, if price starts to break down more heavily here and pull back down to 118, we'll probably just take off the balance for a small gain of about $1.50 or $2. Another recent example that I had on the service just about a week or two ago was Solar City. This is a much higher momentum type of name. So we had broken out. I don't remember the reason why, if it was earnings or not, but had this massive breakout. And and really just traded up strong and finished the day strong on heavy volume. The next day, I was just kind of waiting for some sort of setup to develop, and I didn't like what I saw. And I thought usually when you have such wide range bars, there tends to be a pause or a rest, especially when the stock is really up. I mean, this is over almost a 15-20% gain in one day. You know, you can look back here in September. You have this really big wide range bar, and price just tends to just consolidate, and you know, you don't necessarily see another big wide range bar the next day. It's very rare to see that. So I just kind of backed off. The TA scans page actually picked it up as a breakout day on this day, so it was on my radar. And then I picked it up as an inside day the following day. So that alone just kind of put it on my radar, and I was like, all right, I'm looking for some sort of opening reversal, particularly if it ticks out the prior day's low, because to me it tells me it sucks in some short players. It's also going to stop out some people who are long, shake out the weaker hands. So once it took out the prior day's inside bar here and went positive, you know, above the previous day's close and above the opening for the day, we jumped on board around 46.50. If we look at the intraday action, so here was the breakout day, the big strong day. Price ran up from 42 to 48. Here's that day where I just kind of was hesitant on the market as a whole, jumping, and it really wasn't much of a neutral zone here. You can see the close and the open was really the same. You know, and usually when that happens, you have to kind of wait to see if the prior day's high is taken out. It just wasn't a clean pattern that I was kind of looking for. But this did turn into a nice inside day here. So that did, once it took out 2 days later, once it took out the inside day low, and then I got the opening reversal, you know, we jumped on board mid 46.50, and price just rocketed up to 48 for a fast $1.50 gain. Had you been day trading, that was a very quick gain in about 15 minutes time, right up to the prior day's highs. You know, and obviously you could have taken some off the table, which we did, which we recommended doing. But because of the overall setup and the inside day, I had my stop down here around 45.50. I mean, I really wanted this price action to, it would have to reverse the opening gains and go back and take me out down here. So I just kind of sat with it, and you know, it got a little nerve-wracking because it did come back in a little bit against us, about 50 cents, 75 cents here by the afternoon. But overall, you could see it just kind of turned into another type of doji day, you know, where the opening and the close were equal. You know, and that also put it up on the TA page scans once again as a doji play. So this is a name that it was, at the very least, it was put in front of us as an opportunity. It was a wide range breakout day. It was an inside day. It was a doji day. So this is a stock that you kind of want to pay attention to. Those names on the TA scans page, they focus on the higher volatility, higher liquidity names with your classic technical analysis patterns. You know, so this was just kind of in my face and on my radar to just try to get involved with. Fortunately, the next day it did break out above the 3-day highs at 48. I had a comment that went up that said, you know, price is pulling back here a little bit into that neutral zone, and as the market itself was really, really strong at this point. I think it was rallying for that second day, that gap up, and eventually buyers just started stepping in, taking the price higher, and you know, we had a nice gain there. We took some more profits right here at 52 into the close. And then the rest was just gravy. You know, there was no lower low until yesterday, but I think we got out of the whole thing. It gapped up, and I suggested getting out at 60. You know, just because it just looked so overextended on a short-term basis, up $13, $14. And then once it started closing that gap, I got a little nervous to just take the position off. And right now I'm just kind of waiting around to see if something better sets up for it. Now this does work on the short side as well. Usually, in my experience, you don't tend to see that opening reversal type of pattern on the short side as much. The reason being is when stocks go down, they go down fast and they go down hard. So it's very rare that you get to see a stock, you know, pop higher, you know, float around there, and then completely negative and trap everyone, and then start tanking. Especially lately, it seems like in this kind of environment, when people want out of stocks, they get out fast, and it turns into some sort of big distribution day, trend day down type of activity. But anyway, so anyway, in early October, I was really skeptical about the overall biotech sector. It looked kind of overbought, and I was looking at the individual components, and the action just didn't seem right. It was choppy. It wasn't clean. I was seeing some false breakouts setting up here. And here, this is actually a pattern that I highlight a lot if you're a Briefing Plus subscriber. Briefing, yeah, that's a Briefing Plus. On the liquid momentum focus list and the emerging growth focus list that we have, this is a very common pattern that we see among the leaders, where they make a new high and there's no follow through. And the reversal that ensues is usually pretty strong and on heavy volume. So essentially, it's a false breakout off a new high. When you see this pattern, I know there's candlestick formations of evening stars or dark cloud covers, or there's different formations here. But I try not to get too technical when it comes to the language, because I'm way more concerned about the action itself and what it means. So this is basically a new high false breakout. So once I saw that, I started getting real iffy on the price action, and the market was acting strong, but I was definitely I had very little shorts on, and I knew I wanted some short exposure with an ETF of some sort. It's usually the way I go short the market. I don't like to really short individual names per se, unless I know they're really negative fundamentally, etc. I try to get most of my short exposure through ETFs, only because there always seems to be somebody upgrading a stock, an individual name, as it gets weaker. Somebody's always bullish on a stock as it gets cheaper. So it's very difficult to sit with a short, but usually with a sector, usually I have a tendency to ride them out a little bit better with less volatility, in my experience. So regardless, so we had the stock come down here. We had the false breakout off a new high. So right off the bat, it's on my radar. We had an RSI negative divergence. We had MACDs going negative. So technically, it was just kind of looking pretty toppy up here. It showed up on the TA scans as an inside day right here. And once it took out that low, the market itself, that I think on October 7th, was coming under significant pressure as well. And I just recommended taking a short at 208. In a stock like this, you have to definitely give it some more wiggle room. So we gave it a loose $3, which I believe was the high of the day at the time. So we got short 208. The high was about 211. And, we carried it overnight. Once it broke down below the 20, we definitely knew that we had a much better chances of it, continuation the next day. And this thing just completely tanked with the rest of the market there in early October. And we caught a nice, what was that, about an $18 gain, I think, that we caught down to this, not $18. No, yeah, it was about $18 gain that we caught all the way down to 192 or so. This is a short trade that I took. I only have like two more examples. I'm going to open up for question Q&A. So this is Macy's. It was a short that I took way back in August. The main reason I went short this is because I think the XRT and the RTH, which are retailer ETFs, they were at new highs, and there was a lot of divergences in the names. They looked very overbought end of July into early August, and Macy's was a laggard, probably because of JCPenney, and all their woes that were going along with it. So Macy's was just definitely one of these stocks that I was looking at to look for some sort of bear flag drop as the sector as a whole is about to come off some very extreme overbought readings. So once it broke down, this is a classic. It actually started off as an excellent day trade. We got short around 48.50, and I believe it dropped a full $1, for us to trim some profits on. But then it closed weak. So in my mind, here's a bear flag where we had almost a perfect entry around 48.50, and we already took off a partial profit. There was no reason for us not to hold any sort of balance overnight with the stop right around this vicinity here at 49. The worst case scenario, the stock turned back higher, squeezed us out the next day, and we give back the trade's a scratch. We give back whatever with the dollar gain. When you have such a perfect entry and you've already taken a partial profit during the day, I try to always move that balance somewhere to scratch. You want to give it enough room. And it stinks if you're giving back the profit. I'll admit that it happens a lot. But you capture the much bigger winners that way by not playing, not by playing such a tight game here. So fortunately, there was follow through the next day. So even if you didn't take the dollar profit, you could have locked in some gains there. And at that time, price is below the 50-day moving average. It's below the 20-day moving average, and it was going into earnings. And we had already taken off a partial profit. And once you take a partial profit off, again, I usually will hold a position into earnings. I'm never going to hold a full position into earnings. So earnings came out. The reaction was negative. Price gap down. We locked in another gain of about 250 here. And then the rest, like I said, is just gravy. Just goes sloping down to the 200-day moving average. You could have trimmed a little bit more. It bounced a little bit. I think we're still holding on to a position, I believe. It did crack down to about 42. Now it's around 44, 45 again. But overall, I'm pretty much holding this one short for the last 2 months. Very, very small position. But just basically I'm holding it because of all the JCPenney woes that I feel like this peer is also going to experience some of that downside as well. Another great example was the financials. Again, I mostly use the, especially the weighted, the heavily triple weighted, double weighted ETFs as short candidates when I think they get overbought or oversold. So you can see here in July, this was just up for 3 weeks straight. It was extremely overbought. You had, RSI was getting into overbought territory, and you had a reversal bar there, and we got short right there for a quick gain. Again, it was a day trade initially that we entered on weakness, coming off overbought conditions. So once we locked in some profits for about 2 or 3 point gain, we just held it overnight. And then August 6th, price gapped up. We had these really, really narrow ranges here, and then price started breaking down again with the rest of the market, and we got short again. And then we just, that balance, we managed to carry more significant gains for about $10 or $12 gain, I believe it was, and then we eventually covered when it started showing strength back above the 20-period moving average, and then by the time it gapped up to the 50s, we were pretty much gone. So that pretty much summarizes, that's pretty much what examples of how I approach the market and the type of trades that I present on the Briefing Trader service. Again, I'm very technically oriented. I try not to focus too much on the headlines, but for the majority of things, if you do track my Blue Chip Trader comments on the site, hopefully you can pull up a chart and actually be able to look and see the actual price zones in the areas that I'm actually focused on a daily chart usually. And then, when I reference an opening reversal as the setup, as the key, as the trigger that's putting us into a position, hopefully that should be clear as well, and as well as the risk parameters. So that's really how I've been, just seeing a lot of consistent profits over the last few months. Is just basically by taking those, focusing on the key zones and jumping in on the day trades with the opening reversals or the opening breakouts, and then I'll take some money off the table as it works in my favor, but then I'm just freeing up money, putting money in the bank, and freeing it up for the next opportunity to set up. And I was carrying maybe about 12 to 15 positions the last few weeks as the market bounced and turned and rallied higher. And just slowly just trending them, keep trailing these stops higher above key moving averages, and as they moved out and broke out to higher levels, just take little partial profits here and there, over and over and over again, and that's like the free hassle. That's the hassle-free gains. That's what they mean by letting your winners run. Obviously the key to all this success is always do what's comfortable within your own parameters. Don't ever try to get rich quick by trading large size based upon our recommendations. Always make sure it fits within your proper account size. Make sure that the risk parameters we give also fit into your comfort zone as well. And when we take losses, and the price action turns negative on you, you got to cut it loose. Like I said earlier, it's tough to do, especially if you take 2 or 3 or you're just on a slump. But this game is about preserving capital as much as possible, and then taking advantage of proper price action and proper timing, when that sets up properly. You don't have to feel the need to trade every single day, especially if you get a perfect entry. And many of these examples I show, I had some really, really nice entries on the daily chart that I haven't even been trading the last like 2 or 3 days just because I'm just riding many of my winners gapping up and trending higher. These are just hassle-free gains. And so essentially that's the way that I approach the market and the service that I provide on Briefing Trader. If you have any questions, you can always send me an email to swingtrader@briefing.com. This webinar is going to be recorded, and we also have a YouTube channel at YouTube Briefing TV. We've had tons of webinars over the last year or two, just focusing on different areas of our website that we offer, from the TA scans to the emerging growth list to liquid momentum list to day trading to how to trade earning seasons, earning patterns, which actually I highly recommend watching. That's another one that we posted a while back, last earnings season. It's more focused on how to trade the gap ups and the gap downs, and how to swing trade them and keep a focused eye on them. So definitely check out the YouTube channel for more videos. And if most of you, I believe, are on a trial right now for Briefing Trader. But if you have any more questions, you can always contact them at sales@briefing.com, or just give them a buzz at the phone number. That's about 45 minutes right now, so I'm going to just take a few questions here, and hopefully can wrap this up in the next 5 minutes. Let's see. Yes, everything is recorded, and even the last month's webinar was recorded. Last month's webinar that I did is pretty much the same exact one here. I just added in the opening reversal chart that I showed earlier, along with more recent examples like Devon and Solar City that I jumped on board. APA was an example that APA, APC, NOV, those are all names that I've been involved in the last few weeks. Like I said earlier, I just became really bullish on the energy sector the last few weeks, just based upon the relative strength and the price action and the way it was behaving. There is a Q&A box down at the bottom of your screen there if anybody has any additional questions. Okay, I'm not receiving any questions, so I guess I was pretty thorough. If you have any, if you think of anything, or you go back and review this webinar, feel free to shoot me an email, and I'll try to get back to you within 24 hours or so. So I appreciate your attendance. Thank you.